Welcome. I just want to say glad you're all here tonight. I know it's the dinner hour, so thank you for making it. And I want you to know right off the bat that these sessions are recorded, and I'm pleased that you could join us for the Business Education Resilience webinars with 1917. My name is Pauline Marquardt, and I'm the Executive Director of the Greater Bowie Chamber of Commerce, which is made up of members with common interests and concerns related to the business environment in the Bowie area. It is the primary professional trade organization in the Greater Bowie area, which is dedicated to the protection, enhancement, and success of businesses in the Bowie community. During this webinar, it's best to be comfortable with your video on. Remember to mute yourself. Please ask questions through the chat unless otherwise directed. Joining us this evening is Lisa Smith, and she is the Executive Director of Bowie BIC. And we also have on the call with us today, Terry Rogers, who is the President of the Greater Bowie Chamber of Commerce. And I would like to turn it over to Eric Lindsay. He is a Senior Business Counselor for 1917. Welcome.
Thank you, Pauline. Good evening, everyone. How's everyone doing? Good. All right. Just real quick, I want to do a brief introduction. I'm going to share my screen. So as Pauline mentioned, this is the Business Education and Resiliency webinars. I'm just one of the speakers tonight. Yeah, you also see Charles Mott, Mr. Charles Mott, who's here as well. He's part of the team that we formed for putting together these webinar series. So first, I want to say thank you to the Greater Bowie Chamber of Commerce for allowing myself and my entire team to do this together for the Bowie businesses. I'm a Bowie resident, a longtime Bowie resident. So this is really a great moment, not personally for me and all of us like Charles and all my teammates to do this for our city. So thank you, Pauline, and thank you to Terry for doing this. A little bit about the webinar series. This is a 2-section, 12-part webinar series for a total of 24 webinars. So this is the third installment of the webinar series. The second installment starts April 15th. However, each webinar builds upon each other. So as you're here today, come back next week and bring a friend and bring a business owner friend, because we build the business skills for throughout all the webinars. Now we have a total of 24 webinars, but again, there's actually 25. The 25th webinar is going to be the grand finale, which is July 15th, where we will be doing a Pitch Your Business competition. So again, we're looking for volunteers who went through this program, and we will show you how to pitch your business. We will give you some tips. And then on July 15th, whoever signs up prior to that, well, we will allow you maybe a few minutes to pitch your business, present your ask, and then we will select the first place winner, who will receive a really cool prize that myself and another colleague of mine in the business consulting world, that he's going to be putting together for the first place winner. So this is pretty exciting. It's a really great prize, and I hope that we have a lot of businesses throughout these webinars and into that pitch. But however, I just want to start off with this first. My pitch to you, this is my pitch to you guys, is to ask you just to do this one thing. Sign up for all the webinars and return for all of them. I'm also going to add in there, bring a friend of yours or a business colleague of yours to these webinars, because the more people that we can share this to, the more people that we can educate and get them going in their business. And that's our goal, is to see businesses grow, to see businesses expand. And we're just a very small part of this whole cog in terms of business development. So with that, I just want to say thank you for the introduction, Pauline. I'm going to turn it over to my good friend, colleague of mine for many, many years in the business consulting world. He is going to take you into some business financial literacy. I've seen this presentation before. It's really exciting. So with that, Charles, take it over. Thank you.
Thank you, William. Appreciate that. As William mentioned, my name is Charles Mott. We're gonna first, as we get into these slides, I just want to make sure my arrow key is working here, and it is. Great. So wanted to provide as always, there's always a disclaimer. So wanted to start out with a disclaimer about this webinar. It's for informational purposes. It doesn't constitute legal or professional advice. And it's intended for mass consumption by the attendees here. Um, the listener shouldn't act on the basis of material contained in these slides provided by myself, but we encourage you to work with the appropriate professional that can help you with some of the areas that we're going to discuss tonight. So with that, let's do a dive into here. I'll talk a little bit about myself, and then I want to find out a little bit about you as business owners. So my day job, I'm the Associate Director for the District of Columbia Small Business Development Center. Over the past number of years, and of course, I obviously am only 25 years old, but in the past, I've worked as a co-owner, an owner of a business, a regional manager, a team leader, and project manager, spanning about 35 years. I started out in aerospace, worked in that industry for about 9 years for a very large, nationally recognized firm, and then migrated from that straight into small business. So the change was interesting because I went from being in a very large business environment where I was responsible for a very small portion within my group to wearing multiple hats as a employee in the small business. I worked in that for 9 years. I spun off of that business, and then myself and another person, we formed our own business. And then I spun off of that and formed my own business, and eventually ended up with the Small Business Development Center in DC. So I've learned a lot during that time, especially what I would call lessons learned. And I'm sure all of us on this call who've started our own business have a lot of lessons learned. And I'd like to say I learned more from the failures than from the success, but I've learned a little bit from both. I've counseled and supported hundreds of small business clients during my time. And as it says, over 25 years of experience. I also work with a variety of nonprofits in various capacities, and there's a list of my education there. So I've done a few things. When I saw this phrase, I love this phrase. You're not obligated to win. You're obligated to keep trying to do the best you can every day. And I believe that's not only in your personal life, but also in your professional life, especially as a small business owner. You're hit with a lot of different things, but it's important that you do the best you can every day. And hopefully through this series of webinars, you'll get the right information to do the right things so that you can be the best every day. So before we get too far into this, I'd like to do a little poll to see who's on this call so we can best tailor the information, moving forward. So if you could tell us where you are with regards to starting your business, if you're pre-venture, meaning you're not in business, but you're thinking about it, or you have an existing business. So we'll give it a little bit more time there. Okay, so we have a few more that are existing businesses and some that are pre-venture. So we're going to have some good takeaways here. They're going to cover both of those categories here. And I'm going to just take the poll off here for a second, but now I have a good idea of who you are. These are some of the takeaways I'd like for you to have, coming away this evening. One is, if you're a pre-venture, is how to establish a solid foundation as a pre-venture. We're going to talk about a little bit of those things up front and then walk through some things that are important to your business as we go. Understanding financing in various business life cycle stages. And we're going to talk about what that means both for financing your business and also depending upon where you are in your business life cycle, whether you're just launching it or a mature business, there are different decisions that you make with regards to financing. So we're going to talk a little bit about that. And financial statements in and of themselves, and we're going to talk about which financial statements those are, each have a language in itself. Business has a language, and the language of financial statements as they apply, each has a language in and of itself. And if you have any questions on that, as we go through different parts, feel free to put them in the chat area. William is going to monitor those, and we're going to stop at certain points, and we're going to work on those to answer those questions. Last couple things that we're going to cover tonight, and hopefully you have these as takeaways, is decision making based on financial statements and also SWOT. And we're going to talk a little bit about what a SWOT is and what that means for your business. And lastly, having the right people in place. As they say, or the phrase goes, having the right people in the right seats on the bus. So we're going to talk about what a core team would look like as you build your business out. And there we go. So, where have we been and where are we? So obviously all of us have experienced 2020, and many of us are trying to forget it. But, there are some things that have happened over that time, specifically related to business. And as you can see here, and this is based upon a primarily April, when the COVID first kicked in, the pandemic first kicked in. The number of people who are self-employed went down significantly, 21%, as the slide says, between April 2020 and April 2021. In the leisure and hospitality industry, between May of last year and what's anticipated through next year, that will be down about 41%. And then the 5 weeks after March 13th, the applications for getting your employee identification number as a business fell 27%. And unemployment claims reached 24%. Now with that, you might think that 2020 was a terrible year, and it was, but there actually is a silver lining with some of the things that came out of 2020. So many businesses, and I counsel businesses every day, and I talk to them, and they tell me what they're doing. And when the COVID first started, I was very surprised. Many of them says, well, we're actually doing all right. We've done a few things to help pivot our business, meaning moving it in a different direction. And we said, well, for example, if maybe we were selling all our services and products in person, now we've shifted to using e-commerce as a platform for selling it, and we've been actually more successful. As you know, many of us are ordering on Amazon and other platforms for our goods and services these days, and that's just booming. And this was a trend that many of us saw coming, that business would move more to e-commerce. And what happened was, it was expected to come a little bit later, but because of the pandemic, a lot of that has been moved up much sooner than we expected. Some businesses have been able to leverage some of the loans that are out there, including disaster loans, to maintain and grow their businesses. So while they may not be increasing their revenue significantly, they have been able to at least maintain their business. Now, many of the disaster loans that are out there that some of you may have heard about, such as the EIDL and PPP, those are loans used to maintain the business. But many states and local jurisdictions have also offered grants that allow business to maintain and grow. So those have also been put in place. One of the trends I've also seen too is that many of the businesses that are out there, as they apply for these loans or look for grants, they've been required to provide information to agencies or grant providers. But when they look at the information that they need to provide, their systems don't allow them that. Maybe they don't have a great accounting system in place, or a database that provides some of the information that's required. So many businesses are now using this time now to improve their operations. They maybe have gone from an Excel spreadsheet to using QuickBooks or other platforms to help them with their accounting systems. They're also using these financials and the information they're getting from that, along with the SWOT, which we're going to talk about, to make better decisions. They're using this information they're providing to say, hey, maybe I haven't made that appropriate investment into marketing or other aspects of the business based upon my budget that I established or other information. And they're pivoting or making decisions that will help keep their business and grow their business. And lastly, they're coming to third party both free and at cost services to help them. Maybe they weren't working with an accountant beforehand, but now they are. So you're seeing a lot of changes happen in the business environment. They're actually positive. But I don't want to sugarcoat it. There will be businesses that will fall off, unfortunately. And I was at a meeting early today. We talked about that. But one of the things I want to emphasize, though, is, with the information we're providing through this series, this will help you make some really good business decisions where you won't fall into some of the traps that some of these existing businesses fall into. So, this is a depiction of a traditional business life cycle. So if you're just starting out your pre-venture, you're on the far left there. And over time, your company changes in terms of the definition of where you are. You might be in launch phase. You may be in a growth phase, shakeout, maturity, or decline. Hopefully not decline, but you're in that life cycle extension phase. But when you're just launching your business, you're with regards to sales, cash, and profit, you're very much low there. And you may need startup capital in the beginning, but over time, as a business develops, your sales will increase. Hopefully, your profit will increase, and also the cash that your business requires will also increase there too. So this kind of gives you an overview of a typical or traditional business life cycle. That and the way that curve looks for your business can vary. This isn't an absolute, but this is kind of a standard look at the business life cycle. So we're going to talk, and this presentation is about financial literacy. So we're going to cover some different areas of that hopefully will help you give an understanding of financial literacy. And traditionally, financial literacy has a connotation of credit and debt and understanding those topics. But we're expanding this definition tonight, financial literacy with regards to the business owner, as understanding a little bit about finance, understanding about financials, and so on. So this literacy presentation tonight is going to cover some different things and different aspects of your business. So one of the first ones we're going to cover is sources of financing. And that can vary depending upon where you are with your business. But these are typically what you see are 5 types of financing. We often start out with equity, which in essence means ownership in the business. That might be you. It might be you and business partners. You might give your family equity in the business in consideration for the money that they provide. Another one is private or public sources of equity. It might be venture capital or stock. You might have a third party come in and say, hey, we would like to, loan you this money. We help small firms grow and expand. So that might be venture capital, which is if it's a pure money exchange. In other cases, it might be an equity exchange where a third party comes in, typically, I'm sorry, let me change what I just said there. Venture capital is one who comes in to provide you capital, but wants equity in your firm. So they want an ownership stake in your firm, and for a certain percentage. You've seen shows like Shark Tank. Oftentimes, the folks on there are offering the folks presenting venture capital, and they're looking for an equity stake in there. In some cases, you might have an angel investor. And an angel investor typically is looking to provide capital, but typically wants a monetary or interest on that money that they provide, and not necessarily a venture capital stake. In many cases, you hear about stock options, and that's where a company will sell stock to get capital to grow their firm. A lot of times you see that with firms that are in the IT space. And that's how Google and some of these other firms have gone from working out of their garage to, being the size that they are now. Another one is debt, and traditionally that's through a bank. So there might be a traditional loan through a bank. The bank may be providing capital based upon an SBA product that they offer, and those are called SBA preferred lenders. The SBA aren't loaning the money directly, but they're serving as a guarantor of that loan. And so the bank might have their own loan products, but they also may be an SBA preferred lender. There also may be crowdfunding, and there's many platforms out there you see on the internet for crowdfunding where a group will come together to provide funding to support that business, to help it provide capital. Lastly, there's something called factoring or alternative financing, and that's where you collateralize your invoices. Your business has started up, it has contracts in place, so you collateralize your invoices. In other words, you exchange money for those invoices that have been submitted to the client, and you use that money to help you maybe pay down your labor cost in the short term. And the reason why this is listed last on here is because typically that's one of the last ways you want to finance. That's not one I would put at the top. You typically want to go through those first four before you get to the fifth one. And each situation is different. So your source of financing will really depend upon the type of business that you have, the size of the need of capital that you have, and other factors that are involved. Tell you what, we're going to go a little bit more, and then we're going to take some questions here. So, traditionally, there's been something called the 5 C's, especially in the pre-venture and startup phase where you're looking for a traditional loan. And the 5 areas you see are typically the criteria for that. Character, capacity, capital, conditions, and collateral. So character basically is just what it says. It's looking at your past history on a personal level and how well you've paid back debt on a personal level. Capacity is your ability to pay the loan back. And that could be through providing collateral. It could be through the fact that your business has a lot of capability. They see potential for growth. Your capital need. Is your capital need in line with your ability to pay it back? The fourth is conditions. What are the conditions under which the loan is taking place? And lastly, collateral. What collateral you may have to offer. And this is among many of my colleagues, the last one with collateral. We never suggest that you sacrifice shelter or capacity or to put food on the table. In other words, don't put your house up if you're trying to get a loan. We usually look for other ways to satisfy that capital need. So we never encourage that you sacrifice maybe you put your house up as collateral, but you might consider something something that you have that is of not vital value. So that's another consideration there. At this point, let's see if we have any questions. William?
So far, we don't have any questions in the chat box. However, does anyone have a question you want to jump into at this moment?
And let me know if I'm going through this too fast.
So far, so good, I think.
Okay. So we kind of started out talking about, creating, looking at your character. So, character is based upon your creating a solid personal foundation. And this is where a banker might look at some of the criteria of your personal ability. So if you've paid your bill on time, and specifically more than the minimums on credit cards, definitely more than the minimums on credit cards. Keep your credit utilization below 30%. Now, what that means is, let's say your credit line is, or your credit card has a maximum credit ceiling of, say, $1,000. So in this case, you'd want to not have more than about $300 on that credit card. You want it to be below 30%. Years ago, the criteria or the utilization used to be much higher, but over time, they've lowered that. It used to be 50%. Now most lenders are looking at something below 30% in terms of your utilization. Typically, they want a credit score above 680, preferably more in the 730 region. So it's important that, before you go out and look for lending for your business, that you definitely make sure your personal credit is in line. And also, I would suggest developing a good relationship with your personal banker. So if you have a relationship with them based upon your current your current personal banking, go to them first, because you've established that history with them. You know them and they know you, and then you can expand that over into the business banking side. Now, I will caution you, some banks are very good at the personal finance or personal banking side, but they may not necessarily be as good on the business banking side. So before you make that leap to the business side, definitely, look at your banker and look at their history with regard to small business. I'm not going to name any names for banks in this presentation, but I do know of some that are not as business friendly as others. So I encourage you, before you go to your personal banker looking at establishing that business relationship, do a little research. And if your personal banker appears to be solid in the small business lending aspect, that's the time to kind of look at that. And it's always good to explore that before you actually need the money. As the phrase goes, you want to get that financing when you don't need it, as opposed to getting up to that final point where you need it and you have to do a lot of hoop jumping to get it. Also, co-signing a loan is not recommended, because you can control your own financing, but if you co-sign a loan with someone else, you can't control what they're going to do. So if they default on the loan, ultimately that comes back onto you. So if you can, I would try and, if you do have any loans you've co-signed, try and get those off of your credit before you look for business financing. And always have an air mask philosophy. So that means when you're on a plane, they always say, put the air mask on yourself before you help others. So always try and, if possible, I know that, family comes up, they have a certain need and so on, but oftentimes you have to help yourself before you can help others. So always start with yourself if possible, and then look to helping others with their needs. But especially if you're starting a business, you want to make sure that you're solid in terms of your personal finances before you look to help others.
Hey, Charles.
Yeah.
We have 3 questions and 1 comment, if you don't mind.
Sure.
We have a question. Actually, 2 questions are the same. What is a SWOT?
Okay.
The next
We're going to cover that.
Yep.
Shortly.
Okay. The next question is, doesn't the bank want collateral? Should you use a commercial banker?
Well, collateral may be required if that loan is of sufficient size. They may require collateral. But again, it depends upon the size of the loan relative to your capacity and capability and prior history. In some cases, they may look at your profile and say, oh, well, we can give you a line of credit maybe of $50,000, or we can loan you $50,000 without providing collateral based upon your history, your current income, and so on. So a lot of factors are involved with regards to whether collateral is involved. But again, we don't recommend that you sacrifice or put your home up as collateral in terms of starting that business. You exhaust all measures before you would consider something like that. Hopefully that answered the question.
Yep. And then the other question was, should you use a commercial banker?
I mean, it depends on the type of business that you have. Some businesses on a spectrum, some businesses can be done with your own personal finances, especially if you don't need maybe an office to work out of. You can work from home through your own office. You may need a very small loan. You know, that depends. A commercial banker may be involved, especially if you need a loan of significance.
Mhm.
But
And a comment, and then another question. The comment is, banks also look at how much money you have with them and your banking history with that particular bank.
yep, definitely. Those are two considerations.
Mhm.
Your banking history. So you want to have a really good relationship with that banker on the personal side, and you may even not only do just basic banking with them. And what I mean by that is a checking account or savings account and so on. You might even be doing so. They may even be handling some wealth management for you too. So through those factors, they have a good idea of what your profile looks like and your capability with regards to the business side.
Mhm. And the final question is, explain what a commercial bank is versus a regular bank.
Well, a commercial bank specifically focuses on business as opposed to personal banking, in essence.
Mhm. And those were all the questions and comments so far. Thanks, Charles.
And William, also too, you're also an expert in this area too. So if I'm missing any holes, feel free to chime in anytime.
Sure. Just wanted we're talking, I think you're going to mention this, is what happens is you also see, you mentioned it as in terms of alternative financing, because there's a lot of organizations who also do microloans.
Yeah.
They're not your traditional banks, not like a commercial bank, but they do microloans. And you and I, Charles, we've worked with some of these microloan companies that have a different philosophy and a different system. They're approved to do lending. Of course, they have to go through the jurisdictional state-by-state lending authorities, but they also do a lot of micro lending. So that's also another option when you want to consider funding your business.
And we're going to talk
Yep.
a little bit about financial statements and their importance too. And that's a good starting point in terms of understanding what your need might be. It's funny because we've William and I deal with a lot of small businesses. Sometimes small businesses will come to us and say, well, I need a loan for $25,000. Of course, the next question is, what are you going to use that loan for? And that's where things get quiet, because that amount of money may be considered something they've heard from somebody else, like somebody else needs that to start the business and so on. Every situation is different. So you really need to do some of the upfront work in terms of calculations to find out what your need is as a business. And then from there, looking at how that loan fits into the financials. And we're going to talk about that in a second. And then we're also going to talk about the SWOT too, as we move forward.
There were two additional comments as we move forward. Don't banks have both, the commercial and the regular? I think that's what the person's trying to expand upon.
Yeah,
In terms of both.
yes, they do typically.
Yep. Yeah. And then the other question was, what about the CDFIs for financial support? I think that's something that you'll talk about later. But yeah, CDFIs, a lot of organizations who do micro lending, they have to be CDFI. And it's not just banks, but it's also the smaller micro lending organizations at different tiers of how they lend money.
Exactly. And for those who don't know, CFI is community development financial institutions, and they are basically set up to help a specific community where they are typically located. And you'll find them, a variety of them in this area. known as CDFIs. Typically, they work within the typical loans. They don't typically provide banking functions, but they typically are more on the loan side than they don't do the banking piece as much, but some do. But if you're looking at a CDFI, they typically they can be, and I hate to make a generality, they may have a wider range of loan options, especially if you're a small business, and their requirements can be not as onerous, for lack of a better term, as traditional banks, because they're looking to help that local community. So their focus is, in many cases, to help those small businesses that in that community, help them grow and expand. So they might start out on the small end with microloans, which could be $5,000 or less, and then have different loan groupings based upon your need and how long your business has been in existence, whether it's a startup or you've been in business longer. So there's a variety of CDFIs that are out there that provide flexibility. And again, as you're looking at lending needs, I encourage you both to look at traditional banks and also CDFIs with regards to the options each one have, and make an evaluation that's best fits your situation.
Thank you, Charles.
So now we're going to talk a little bit about financial statements. We've kind of touched on it, but we're going to talk a little bit about the value of financial statements. And what we touched on this briefly, that forecasting is important. And the three key financial statements are the income statement, the cash flow statement, and the balance sheet. And the income statement is also known as the P&L, profit and loss statement. And so we're going to talk about a little terminology here. If I don't mention or you don't know of a term, let me know and put it in the chat area. And again, we're going to take a couple breaks here as we move through this presentation on financial statements and talk about the importance here. So these statements, these three are basically your linchpins of financial statements, and they each tell you a different piece about your company. And we're also going to talk about how they are differentiated and what and the value of each one with regards to information about your company. And I like to use the analogy of when you go see your doctor, you get your blood pressure taken, you get your glucose level taken, they weigh you. All these are quantitative aspects that tell how well you are doing from a health standpoint. These statements each provide, excuse me, a financial health or indication of how well your company is doing from a financial standpoint. Each one provides a different aspect of the health of your business. And in totality, they give you a great picture of where you are. So not only you can use this to do forecasting, to put in the numbers to look at what your business might look like as a pre-venture. For companies that are in existence, historical statements can provide trends and patterns for your business. Am I making a profit? Do I owe too much relative to my assets? What is my cash flow? Am I profitable, but at the same time, I'm running out of cash in the business? So they give you different aspects and different information based upon your business. And it also allows you, especially in terms of the historical piece, allows you to do some correction as situations may pop up. And we'll get into this a little bit more. And at the appropriate time, they can be used to help you with expansion and growth of your business. And also, for information that's out there, you can do industry comparisons. So you may look at some historical data, some aggregate data about an industry, and compare it to what your statements look like. And it can tell you whether you match up to that industry, and if you need to make some decisions based upon where you are. So the first one we're going to cover is the income statement. It's also known as the P&L statement. And the income statement is based upon business activity during a period of time. So it might be a quarter, a year, half year, and so on. So on an income statement, it might say income statement between January 2021 and March 2021. So it covers a period of time, obviously because you earn revenue over a period of time. And the pieces of the income statement are broken down accordingly. And this is at a very high level. At next week's session that we're going to cover financial statements in more detail, and we're going to get into the nitty gritty here. But this is just to give you an overview. And I know for some of you, after we get through with this, you'll be saying, okay, I have had enough information, stop here. So we're going to give you enough to help you to whet your appetite, but we encourage you to come back next week where we get into the details about each of these statements. So at the top level, on an income statement or P&L statement, there are revenue and sales. These are synonymous terms. They mean the same thing, revenue and sales. The next thing below that is your direct cost or cost of goods sold. The best way to describe that element is, or that part of or that line item on your income statement is to say, those are the costs directly associated with producing a product or providing a service. So if you're producing a product, it might be the materials involved, shipping, the labor directly involved in producing that. And we're going to differentiate it from the operating expense in a second here. So the direct cost or cost of goods sold, those are what you subtract off directly right under revenue. And your revenue and sales, and again, we're going to talk about in more detail next week, that revenue or sales might be net revenue because you may want to subtract off returns that are done. So if you sell clothing, let's say online, and a certain portion are returned during that period of the income statement, you want to subtract that off and then subtract off your direct cost. But your direct costs are the costs associated with producing those items. Once you subtract off your direct costs, you then have what's called the gross margin or gross profit. That's the amount. The reason why they call it the gross margin is, or another term they use is even contribution margin, is that's the amount you have to contribute to your operating expenses. And so if you notice, we call the direct costs, and the operating expenses. Both of those in and of themselves are expenditures that a business has, but each one is slightly differentiated by the terminology, direct cost and operating expenses. So your operating expenses typically are the things that you are periodic and happen every month, let's say. So it's your salary, your marketing expense, your insurance, your cost of your expense related to paying for a lease on a building. Those are recurring costs, insurance, and so on. All of those are your operating expenses. And again, you want to differentiate those from your direct costs, which are expenses associated with directly producing that product or service. After you subtract your operating expenses out, what you end up with is your net income or loss. A lot of people confuse revenues with income. Revenue is the top line and income is the bottom line. Your income is what you have after you subtracted all of your expenditures out. And again, it could be income or it could be a loss depending upon what your expenditures look like relative to your revenues.
Hey, Charles, we have two questions.
Sure.
One is, what is cash flow? I think that's something that you'll be talking a little bit more in shortly.
Mm-hmm.
And the other question is, what is cost of goods sold?
Okay.
And a question to Pauline is, will these slides be available? I think Pauline is actually recording this entire series.
Mm-hmm.
So I would say yes, Pauline. You want to answer that real quick?
Pauline, I think you're muted.
Yeah.
I believe we can make them available. under request.
Great.
Great, great. So the first question to you, Charles, would be what is cash flow and what is cost of goods sold?
Cash flow is different, and we're going to talk about it in a second. And when you've talked about the income statement, cash flow becomes much more obvious, hopefully, in its connotation. So we're going to talk about that in a second. Going back to the other question with regards to direct cost, again, direct cost or cost of goods sold are those costs that a firm incurs to produce a product or service. So let's give you an example. Let's say that your company makes tables. So the cost, your cost of goods sold, and that term is specifically or typically used with a physical product. Direct cost is typically used with regards to services. So let's take the cost of goods sold first. So we're talking about a physical product here. So what it takes to make that would be your cost of goods sold. So that might be the cost of materials to make the table, the wood, or other materials associated with it, the labor to make those tables, and any other associated cost of producing that good. And again, it's separate from your operating expenses because those are expenses that you would incur on a monthly basis. Your cost of goods sold can vary depending upon your production level. So from one month to the next, it may take more materials if you're producing more tables, or it may take less, or you may incur less cost of goods sold related to labor if you're producing less tables. Direct cost is typically a term you see if you're providing a service. So those might be the people that you engage as subcontractors to help you provide that service. Or let's say that you're providing a service where you might be producing materials for that customer, say binders. Let's say your service is you do training, and you provide the customer with binders. So that cost of the binders is a direct cost. It's a cost directly associated with providing that service to them, which manifests itself in terms of revenue. If you're not producing anything, nor are you providing a service, that cost or cost of goods sold would be zero. You still may be incurring operating expenses. You may not have any revenue in a given month because you haven't had any costs associated with it, but your operating expenses are still there. You're still paying for office space and so on. So that's how you differentiate the two there. Hopefully that explained the difference there. Lastly, I want to talk about accrual versus cash accounting. So the best way to equate it is to provide an example. Let's say that you have a hot dog stand on a corner. Typically, all of your revenues are instantaneous, or your sales are instantaneous. They're right there. So, you're producing hot dogs, you're selling them, that revenue is then generated. That's a cash basis for accounting. A sale happens, it might be cash, it might be through credit card, but still, again, it's both treated as cash. Accrual accounting comes in where you're accounting for, say, you're producing a product. Let's say those tables that we just discussed. Until you ship that table, you don't count that as revenue. So accrual-based accounting is based upon from a producing a product aspect. You don't count that as revenue until you ship it to the customer. If you're providing a service, you don't count it as revenue until you provide that service to the customer. And that's when that's the accrual side, as opposed to cash accounting, where the revenue is counted instantaneously upon the sale.
So
I'm definitely going to ask if there's questions there, because that could be a concept.
Yes, that was perfectly perceived on your part, Charles. We do have, let's see, one, two, yep, we have two questions. One is, for those who are developing their own income statements,
Mhm.
what are your recommendations for capturing these business activities and numbers so they are correct and then generate the income statement?
I think there's two parts to it. One is to use a good spreadsheet, and the other is to bring in a third party to help you, whether that be a free service or a paid person to help you. It could be an accountant that helps you correctly put together your income statement. The key thing you want in there is to accurately um, estimate your revenue, your direct cost, and so on. If you're a pre-venture company, this is a future look at what you think your company will generate. And also keep in mind, for some businesses, there's a seasonality to those revenues. So if you have ice cream, let's say you produce ice cream, pretty much between November and March, you can pretty much expect your sales to be a little bit lower because people may not be buying that ice cream. Although I would say in the pandemic, that's a comfort food. So most everybody's eating ice cream these days. But in typical times, your ice cream sales may go down. If you make umbrellas, well, not umbrellas, but if you make winter coats, your sales are probably up between October um, and March, but they will probably go down between the rest of the year. So as you do your forecasting in your income statement, you also want to consider seasonality.
Mhm.
A big part of putting an income statement together is doing the research, and that's in general. In general, you want to do a lot of research. We kind of talked about it before with regards to seeking out a banker or seeking out a source for financing. It all comes down to the research and making a choice there. In this case, you're doing your research about, and I'm bouncing back to that example of the tables. If you're producing tables, you want to research, well, how much is it going to cost me for oak if I'm making oak tables? How much is it going to cost me to ship those products and so on? So those are the kind of costs that you'd want to investigate to put in your statement in terms of direct costs. Your operating expenses, let's say you had to get insurance for your company, you'd want to look at that and do some research maybe among several companies about insurance, or in terms of salaries that you put in under the operating expenses. How what if I'm an employee, if you have employees, what your typical cost of benefits are, and am I uh, looking for a benefits provider, and what are costs associated with that. So that's those are some of the considerations. Hopefully, I answered that question.
I believe you did. And the one thing I would add to
Mhm.
the individual asking about if you do this on your own and how do you accurately correct your statements. The one thing, and I think Charles mentioned it earlier, was the way you set up how you capture your expenses and your income is called a chart of accounts.
Mhm.
So that's also very important to have. So it's really just a way of just you know uh, categorizing the activities in your business that it's related to your business. So if you're in sales, if you're selling a product, or if you're selling a product and you're also doing services, two different things, then your chart of accounts are different in those two areas. They're not the same for every business. So that's one of the first steps you do in setting up your financial records. And even if you use any software that you use for that, the chart of accounts is one of the first things that your software does. We have let's see, we have three additional questions here, Charles, if
If
you
I, if I, William, if I could add
Oh
on
yeah.
to that also too. I know part of the question was suggesting any software for that. So your income statement can be as simple as using an Excel spreadsheet to put that together. You want to make sure the math in the spreadsheet is correct, and also that you've accounted for all of your direct costs and your operating expenses. There are more sophisticated approaches where you look at something like QuickBooks, and you can do some forecasting in QuickBooks. You may also want to consider using something like LivePlan. And LivePlan is a software that allows you to do forecasting in there, put your business plan together, and so on. So it's a fairly complete software. It also allows you to do some ongoing to do some dashboarding related to ongoing operations of the business. So once you put your finances, your projections in there, and once your operations start up, you can use LivePlan to monitor the business and so on. And it also has a resource area where you can look at business plans that include finances that are already done within those business plans. You can use those as an example. Depending upon your specific business, it can lend itself to telling you, here's the things that I can expect in terms of direct costs or cost of goods sold or operating expenses.
Yep.
And it'll help you set that business up properly.
Yep. Definitely the life plan. You and I, we use that with a lot of clients for business planning and for what if scenarios. We can also do some what if scenarios in there and strategies and things like that. So one question was, I think we answered one question with that, and it was, is there software that helps with this? Hopefully we answered your question on that. Just give us a thumbs up if we did. And the other question is, what about a sale by credit card?
A sale by credit card is treated as a cash sale.
Mm-hmm.
So what you may want to do is estimate your you may capture revenue both from cash sales and from the accrual. Most income statements are set up in the accrual fashion. So what you would do is estimate those sales for that given month, both from an accrual basis and also any cash sales you would estimate for that. So you would include both in there.
And the next two questions, they're pretty much the same. So I'll just tag them together. Is an income statement about future sales? And the other question related to that is, what is the difference between a forecast and an income statement?
An income statement can both be a historical look, which is what's happened in the past, and it can be a future look. The way you know you're looking at a income statement for the future, on there you may see the term pro forma, P-R-O, and then forma, F-O-R-M-A, pro forma income statement. That's basically saying that's a forecast. That's what I think here's what I think my income statement is going to look like with a future look as a forecast. Pro forma income statement and forecasted income statement are synonymous terms.
And that was all the questions that we've had so far.
Great.
Great questions, guys. Thank you so much.
And did I mention the quiz that we're doing tonight?
That's coming up next.
It's multiple choice, by the way. Also, I just want to do a revisit to the language of the income statement because it can be confusing. And you want to make sure you're using the right terminology. I was in a meeting last week where somebody used revenue and income synonymously, and I had to correct them during the conversation, say, no, revenue and income are two different things. So your sales and revenue, think of it this way, your sales and revenue, sales or revenue, depending on what term you use, are your top line. It's a top line of your income statement. Your profit, earnings, and income are the same, and they're really your bottom line. The net of it is your bottom line. And again, revenue and income are not the same. So revenue is what your company generates, from sales. It's the top line. Income is what you have after you've subtracted all of your expenditures. And again, I mentioned it earlier, costs are different from expenses, but both of them are expenditures. There's a good book that is mentioned at the end of this presentation. That's a good book to have on the shelf, and it talks a lot about the terminology and semantics financial statements. Sales equals shipments but not orders. Again, we're going back to that accrual definition. Once you ship something, it's considered a sale and is counted as revenue. And that's from a product standpoint. And profits are different than cash. And we're going to talk about cash flow, and we'll tie in the income statement relative to cash flow, and we'll show the subtle differences. So cash flow statement, perfect segue. So the best analogy I have for your cash flow statement is think of it as that statement you get from your bank at the end of the month. You have a beginning balance that you have in your account. You have cash receipts. Those are your sales generated during that given period. You have cash disbursements. Those are what you incur in terms of expenditures given that time. You might get a loan during that time. So that actually, if you notice the plus sign there, it actually increases the amount of cash you have during that given period. Again, just like the income statement, the cash flow statement is over a period of time. As you can see in the example to the right here, we have 2 months of a cash flow statement on this. So, and then you have an ending balance. So again, income does not equal cash flow. So again, when you look at the components, you have a beginning cash balance, which is what you have in your account to start with. You have money that's come in over the course of the month. You've expended money over that month. You might have gotten money in. It could have been through a loan or a grant. That increased the amount of cash that you have. And then ultimately you have an ending cash balance. So if you look at the ending cash balance for a given month, and let's say it's month 1 in this example here, in this figure, it becomes your beginning balance in the beginning of month 2. So it very much works in line with your what you get at the end of the month when you get a statement from your bank about what's happened during the course of that month. When you compare it to the income statement, you could have a company where you are making a profit, but at the same time, cash flow you could be leaking it like a sieve from your company in terms of cash. So that's why we talk about having all 3 financial statements, and we're going to talk about the balance sheet in a second. But you have to have all 3 statements to give you the true picture of how well your company is doing. And again, if you're looking at that future look, again, you can do the calculations on what you think your company is going to look like in terms of cash flow and do a future look. And then you can make some decisions based upon what you estimate and alter these and modify them. And again, as mentioned, a business can show a profit, but can be hemorrhaging money at the same time. So you can have 2 things happening at the same time. And if you just look at the income statement, you can say, well, I'm making a profit, but at the same time, after 6 months, you're going to be running out of money. So you want to look at all the components at one time to make sure that you have a true understanding of where your company is. William, any questions so far?
No, so far so good.
Okay. Lastly, this is the balance sheet. So a balance sheet, and I like to equate it to the personal equivalent here. So if the personal equivalent of a balance sheet, the balance sheet refers to a business, your net worth is essentially the equivalent, your personal net worth is the equivalent of a balance sheet. And what I mean by that is you have assets that you own as a person. You have liabilities, or you have things that you owe. And the net of that is your net worth on a personal basis. So you had everything that you own and subtracted everything that you owe. What's left over is your net worth. So let's transfer that same mindset to business. Your business says the same, your balance sheet says the same thing. So your assets are what the business owns, and they could be physical goods or physical things. They could be not non-physical. You have liabilities, which is the equivalent of what you owe. And lastly, you have owner's equity. The reason why they call it the balance sheet is if the assets are on one side, your liability and your equity are on the other side. They're balanced out. They have to equal each other. So if you notice an example on the right, they have a whole set of assets here, which include cash, which is a very liquid asset. You have receivables, accounts receivable. So if you invoice someone, you've provided something to them, and you invoice them for what you provided to them, those are receivables. Those are basically IOUs to your business. You might have inventories, and let's go back to the example of you're producing tables. You produce so many tables, but you haven't shipped them, but you have them in inventory. They have a value. They're an asset. You might have prepaid expenses. So if you've paid insurance and other things, it counts as an asset because you've prepaid it in advance of that period of time that they cover. So there are assets there. If you notice, the assets fall into two categories: current assets and fixed assets or long-term assets. On the fixed asset side, you might have a building that has land with it. In this case, they don't indicate land, but let's say you have a building there. You have machinery that you're producing your products with, office equipment and so on. Those are called fixed assets, and they have a value. And if you look at this, when you add up the current assets and the fixed assets, there's a total asset value there, $165,000. So on the liability side, you can have accounts payable. That's where a vendor has invoiced you and you owe money on that. You have taxes that are due and other liabilities. Other liabilities could include credit cards. So maybe the business has a credit card. You've bought raw materials for the business on those credit cards. That's a liability. And they have current liabilities listed there. Current liabilities are liabilities where are less. They can be paid off in less than a year. A long-term debt in this case might be the mortgage on the building that you own, and that'd be a long-term liability. So collectively, all the liabilities in this example equal $100,000. So if you take the assets and subtract the liabilities, what's left over is your equity. It's your ownership in the company. And in this case, it says common stock. But let's say you didn't have a stock-based company. That $65,000 might be retained earnings. Those are earnings that, and again, we're going to tie it into the other financials. Those are earnings those are the net income that you've plowed back into the business over time. The balance sheet is a little bit different than the income statement and the cash flow statement in that both of those statements cover a period of time. In other words, you generate revenue over a period of time. It might be a month, a quarter, or a year. The cash flow statement, again, is over a period of time. Your cash flow is over a quarter, a month, a year, however you specify it. But a balance sheet, if you notice, is a snapshot in time. It's as of a certain date. And so on there, at the top of this example, it says prepared on 9/15/2015. In other words, it's saying, here's what I own, I owe, and my equity on that date. It's a snapshot. So, for instance, where you'd get that cash amount that's listed there is you would log into your bank account and say, here's my balance on September 15th. Here's how much inventory I have on September 15th. If I looked at a month later, these amounts could change. They will, and definitely will not be the same. So the balance sheet is in terms of coverage is specifically is a snapshot and a specific date in time. Will, any questions so far?
No, I think there's no questions. So far, so good.
So let me go back just a second. So I want to talk about how the statements tie together. So if you notice on here, we talked about the cash that's in the bank on this date. So let's say this was the end of the month, September 30th. The way you get that cash amount on there, it would be from your cash flow. Let's say your cash flow is at the end of, you did month 1, month 2, and so on. And at the end of on September 30th, your ending balance is for cash in your account is $17,250. So you take that amount from your cash flow statement and you would put it in here for your on your balance sheet. Other parts of this tie in the same way. You might pull some of the information related to liabilities from your income statement, what you may owe, and tie it in there. So all of your statements can be tied in together. I also should point out too that with regards to fixed assets, and again, we're going to get into this more in the next webinar. Your fixed assets are your assets after you've subtracted out depreciation. Depreciation is a non-cash expense, and your machinery has a certain value, but over time it depreciates in value. Great example is you buy a vehicle. As soon as you take it off the lot, it's worth less than what you paid for. That's depreciation. It's worth less. So you would on these on your balance sheet, you want to make sure that you include depreciation. And depreciation is something that shows up not only on your balance sheet, but it also shows up on your income statement. So all of these statements are tied together in some form or fashion. And again, all three of them tie together to give you a perspective or the health of your company as you look at all three of them together. Now, we've talked about them and the different things that they tell you about your company, but there's certain information that you can also get from it that also, if you're going for a loan, that the person who is providing the loan will ask. So those are typically financial ratios. And so common sizing, and again, we're going to talk about it in more depth next week, is where you look at your statements. And while you look at the raw numbers, you can also take them and look at them in terms of percentages relative to for the income statement in terms of revenue. What do all the other numbers on your income statement mean relative to the revenue? Or in terms of assets, my percentage of cash in terms of my total assets, et cetera, et cetera. So common sizing is where you provide additional detail of information. You can also, there's liquidity ratios, asset management ratios, and profitability. These are all ways that you can provide you with additional information to help you make decisions about your company. So your current ratio is, for example, and again, I don't want to get into too much detail today because I know we're getting low on time there and I want to cover some other things, but each of these ratios provide information about your capability, let's say in the terms of current ratio, maybe to pay a loan back. So they look at that and say, do my current assets exceed my current liability? And obviously that number should be greater than 1. You want your current assets to be greater than the current liabilities that you have. So when you look at that, or when your banker looks at that, they will take several of these ratios and pull them out and do some quick math to see, they have a benchmark. And so if you meet that benchmark, then they'll use some of this information to make a determination regarding a loan. The asset management and profitability are also ones that they may use, and also you may use to determine any decisions you need to make in terms of your inventory or sales, etc. So the SWOT analysis. So a SWOT analysis is a great tool because whether you're in a pre-venture stage or you've already started your business up, it can be a tool to evaluate where you are and where you'd like to be. So there's 4 components to it: the strengths of your business, the weaknesses of the business, what are the opportunities out there for the business, and lastly, the threats to the business. And these are basically evaluating different areas of the business. So if you're pre-venture, you might say, well, at this point in time, again, it's treated as a snapshot. You might say, I have a high cash balance, which means I may not need to borrow money, let's say. Or you might have an intellectual property such as a patent or trademark that you can apply that can be a strength of your business. A weakness might be on the alternative is, I don't have a lot of cash. I'm going to need to get a loan for the business. Or my marketing isn't very weak. I need to improve that area of the business. Your strengths and weaknesses are internal to the business itself. Your opportunities and threats are external. It's outside of your business and what is out there beyond the so-called walls of the business. So your opportunities relate to the markets that are out there for you to tap into, clients that you're looking at, the business environment. So right now, if you were thinking of starting up a restaurant with dine-in, now is not a good time, obviously, because of the pandemic. But your business might be, the opportunity might be for delivery, a food business can deliver. The typical threat to a business is typically, and again, it's external, is the competition or the business environment at the time. There may be certain regulations associated with the business that you're either have or propose to have that might affect the viability of that business. And again, all of these are different depending upon the stage of your business, but it's a great tool for allowing you to look at the business and do an evaluation of it. It doesn't have to be a big narrative in terms of putting this together. Each component of this can be done in a bullet point fashion, and it can be done in quickly as an hour. What we suggest, and William and I work with a lot of businesses, we suggest you maybe get a third party to help you walk you through this your first time. And then after that, you can once you become comfortable with the tool, you can continue to use it and grow and use it at certain times. We advise a lot of our clients, especially existing businesses who are in the pandemic, to do a SWOT analysis, to provide them with a point in time of where are you now? What do I need to do to pivot, to change my business around, or to make decisions based upon that? And again, you can utilize it any life cycle phase of your business.
Mm-hmm. Hey, Charles, before we get too far, there was one question based on the cash flow statement, if you don't mind. I can
Sure.
Okay. So the question is, my understanding is that only an accountant should prepare a cash flow statement.
It can. If you notice the cash flow statement that's proposed here or shown here is very simplified. And one of the things I didn't mention, I'm glad you brought that question up. If you're using accrual accounting, you have to convert the statement to cash. So that involves making some alterations to the cash flow statement, and you really, in that case, should bring in a professional. Now, if you have a cash-based business, it becomes more simple. But if you have a business where you're delivering, you're shipping a product to customers, or accrual-based accounting would apply, you probably should bring in a third party to help you create the cash flow statement.
Thanks for that, Charles. That really helps, and that's something that no matter what type of business you're in, or even if you are an accountant and you do your own books, it's always good to have someone else take a look as an accountant or a CPA or a bookkeeper at a minimum, to take a look at these books, even if you're using software, because a lot of us rely on the software. We still need that extra professional eyes to make sure that these systems are set up correctly. When you produce the report, is accurate, our data entry is accurate. So it's always good to have an extra set of eyes who are professionals in that field, who can say, okay, try this, try that, tweak this, or tweak this entry, or this entry wasn't properly entered, things like that. So it's always a plus to have a second set of eyes on that, no matter what kind of business you're in.
And we're gonna, in a second here, there's a slide here that talks about, the team that you should surround yourself with.
Yeah.
And we're gonna talk about different roles.
Yeah. And thanks for mentioning the SWOT. Yeah, we talked about this in the first last week in the business planning webinar. The SWOT is so important, especially as you mentioned, Charles, under this pandemic, under what's happening now, is a lot of businesses are actually shortening their window to do a SWOT analysis, even at a minimum.
Yeah.
And the one thing I like about the SWOT is we look at it for businesses, but we also should do a personal SWOT.
Yeah.
We should always do one for our own skill set and for ourselves, not just for the business. And
that's a very valid point, especially as a business owner. So your strength as a business owner might be you're very versed in the area of your business. Or maybe your weakness is you're thinking about going into business in a certain area and you're maybe not well versed. And it might be in a subject matter area. So you may be really good at producing pies, and that's your strength because you have that technical skill, but your weakness might be that you don't know finance or marketing or the operational side. And that's where you bring in a third party. So that's a very good point, William. Any questions on the SWOT?
No, that was it. That was the last comment there for
Great.
now.
So this perfectly dovetails into our next topic, which is your typical advisory team and the role that they play. So, obviously, as you look toward building your business out, these are your typical people that you should consider as bringing them in at some point with regards to your business. If you're a pre-venture, you may be looking at putting contracts together. You may need to, bring in subcontracted labor, things like that. So you should really bring in an attorney, and it specifically depending on the situation. It might be a tax attorney, it may be a contract attorney, or some specialist in the legal profession. You may want to bring them in to provide you with that help before you proceed with a certain aspect of your business. The bookkeeping, and I clearly differentiate between bookkeeping and accounting. A bookkeeper is someone who basically helps you with the day-to-day transactions. You give them your receipts, your invoices, and other things, and they enter them into your accounting system. They may generate the invoices for you. You tell them that you owe that you're billing such and such a company. They will put that information in there and set that up for you. So bookkeeping typically is associated with day-to-day transactions and the help you need in terms of getting them in the system. An accountant's role is a little bit different. It can be synonymous with a bookkeeper. You may have an accountant that provides bookkeeping services, but depending upon your capacity, you sometimes can differentiate or should differentiate the two. The accountant is somebody that you can bring in on a periodic basis to oversee the work of the bookkeeper. And it serves as a check and balance between those two specific skill sets. The accountant is there to be that extra pair of eyes, and as William mentioned, their eyes are there to make sure the bookkeeping has been set up properly, to make sure that the work has been done. The worst thing you can have is your accounting system is not set up well in the beginning, and it ripples down. You can imagine 10 months later if you found out that your chart of accounts was not set up properly, all that information you've put in there now has to be reevaluated and reanalyzed and updated. And of course, that comes with an expense. Now, I will say this doesn't negate the fact that as a business owner, you should be knowledgeable about the areas that we just covered in terms of the income statement, the balance sheet, and the cash flow statement. You should be knowledgeable on that. You don't necessarily have to be a bookkeeper or an accountant or a CPA, but you should be knowledgeable to ask the appropriate questions to those members of your advisory team. In some cases, and again, this can be a blurred line, your accountant and your tax advisor can be one and the same. It may be a CPA that provides both services, but I am differentiating between the two because they serve different roles. Your tax advisor is not somebody there just to provide you assistance when it's tax filing time. You don't want to go to their office with this box of receipts and say, sort this out for me. What you want to do is use them as a resource throughout the year in a specific ways. So I'll give you an example. You're an existing company, you're up and running. You notice that you're getting to the last quarter of the year. You have a lot of cash on hand, and you want to reduce your tax liability. You may want to talk to your tax advisor maybe in September or October to say, look, I have all this cash in my account according to my balance sheet, and you want to make sure that you don't have a big tax liability. So you can talk to your tax advisor to help you look at ways to reduce that liability. And again, you look at both the income statement and the balance sheet. And what that means is you may talk to them and they say, hey, you had mentioned about purchasing some capital equipment for the business. Now is a good time to do that. That reduces your tax liability and will help you in terms of having that equipment available to increase your capacity. So your tax advisor is there to help you at appropriate points throughout the year. The financial advisor is somebody that works with you, and separate from the other folks there, their role is really to look at where you are and what's the end game for your business. They would help you with setting up a retirement account for the business and helping you make decisions, sometimes or most likely in conjunction with all the other folks we have listed there. Again, they're a team for you and they work in concert, and each one needs to share information pertinent to the other to help you make important decisions. And lastly, of course, in today's world, we all depend upon technology, whether it be accounting or other parts of the business. Your information technology piece is very, very important. And the person that advises you important. The person who's your bookkeeper, accountant, tax advisor, or financial advisor may help you with portions of that. But in totality, in terms of your operations, you want to make sure you have a good IT person in place to advise you on what you need to help you with your operations. There may be things that you've done maybe as an existing business for years, where you really could automate that. And again, as mentioned earlier, in the pandemic that we're in now, many companies are reevaluating that and saying, I've been doing our operations a certain way for many, many years, but what are some things I can do for more efficiency that I can, and so companies are doing a reevaluation of their IT platforms, and looking for ways to automate their systems to be much more efficient. And as we move forward, as you see firms, move forward, many of them haven't done that deep evaluation. Another aspect that we haven't mentioned is, and what's very pertinent now is many companies are dealing with cybersecurity threats. So it's important that your IT person is there to help you not only pick the right platforms, but make sure that you have the appropriate security. There's nothing worse than having your information hacked or ransomed. And as a small business, you can't afford that. It can shut your business down. So all of these folks that are listed here play a certain role in helping your business both establish the business as a pre-venture and to help you move forward. And they can be brought in accordingly over time, depending upon the need that you have or requirement of the business. William?
Yeah, thanks, Charles, for the. I'd like to add one of the folks that we should always add. I would say number 7, would be your business coach or business consultant.
By all means,
always
definitely.
always have that person on your team. And to piggyback on what Charles is saying, that's such excellent advice. One of the things that we've always told our clients to do was, especially with the pandemic, especially what happened last year, start looking at your tax when you go to your tax advisor, your CPA, and the people who prepare your taxes, especially this year, it's coming up actually. You also want to talk to you want to ask those questions in terms of tax strategy. What are some of the tax strategies specific to your financial situation in your business that you can actually offset your taxes for next year? How do you play that tax game? Because taxes are going to change they change every year. There's a new administration, for example, so I'm sure some of the tax structures will change, some of the incentives will change, and your tax advisor, who's an eCPA or a tax strategist, you want to ask those questions ahead of time. For example, because like with PPP and the EIDL, how do you manage those particular pots of money within your business? What is the tax strategy down the road for that? So, and obviously ask your business coach and business consultant as well, have them on your team as well. But we do have 2 questions for you, Charles. I'm going to read them off to you. The first question is, many small businesses, and I know Charles has the perfect answer for this, so this is a home run question.
No pressure, no pressure.
No pressure at all. Many small businesses and sole proprietors do not have the resources to pay for most of the typical advisory team members listed on this slide. Can you recommend where we can go for free or inexpensive advisory services or resources?
Sure. I'm glad that was an easy one. As mentioned in the beginning, I'm the Associate Director for the Small Business Development Center Network. And we actually provide free counseling services to small business. There's a SBDC network in every state. I happen to be with the one in DC. We service DC residents with businesses or folks from outside the area who are trying to establish a physical presence in DC. We have a counterpart in Maryland, Virginia, and every state in the union and U.S. territory. So we're essentially everywhere. We're one of a plethora of free resources. I think that's a great place to start. In addition to ourselves, there's also the women business centers that are located, in DC and other locations, and also SCORE. SCORE is another small business SBA resource partner. And again, we're not part of the SBA, but we are resource partners that work in concert with the SBA and are grant funded through them. So they're a good start. But I wouldn't encourage, as you grow and expand your business, they have a shelf life. Free resources have a shelf life. And I encourage you, if your business is growing and expanding, there's a point where you want to pay for resources that are dependent upon what your need is. So, we don't provide legal help per se. There are free resources for that. DC Bar Pro Bono is a resource in DC that helps provide free legal service. But again, their services are limited, and other free resources have limitations. So at the appropriate point, your business counselor can say, I think you need to look at a third party. But we're a good start for that. We can help you all the way from ideation all the way through getting your business plan going, and even helping you seeking financing.
Great. Yeah, perfect. Well said, Charles. It's always good to start off and sort of, start the race on the right foot. And as you grow your company, you definitely want to bring these people on your team, whether you hire them as consultants or you hire them as a full-time employee. You never know that your business can definitely grow to that extent.
And I should also mention too, and I didn't bring up this point necessarily in the beginning of the presentation, but in terms of financing, especially in the pandemic now, many firms are looking toward grants that are out there. And so that grants, the amount of grants that are out there in terms of financing to get your business up and running, or either for existing businesses, there are grants that are out there. It takes some research on some of the websites, including our own at the SBDC. We have some information about grants that are out there. They can be both through agencies, and they can also be through private foundations or private companies that are out there. So, Goldman Sachs might have a grant, or Visa might have a grant, or it might be through DC government or through Maryland State. All of them have their own grant vehicles. And one of the books I believe I put on my list at the end here is a book related to finding sources of money that can be helpful.
Yep. And the other question is, and this is a pretty specific question, is it worth it to keep paying business insurance when the service has changed from in-person kids and classes and camps and programs to a virtual platform?
Well, I'll answer that question this way. I think you have the appropriate insurance that meets the regulatory requirements for your industry. Insurance is part of risk management, and insurance is part of making sure your business is ongoing and not liable for certain things. So it's important that whatever insurance is applicable, if you change platforms for your business, you should do some research and check with your insurance provider on what your need may be, or through the regulatory agency associated with the city or county that you're in, on the appropriate insurance for that business, whether your business is in a certain place or you change the business.
Yep. And the last comment was, thank you, Charles, for answering the question.
Okay, thank you. So this is a bit of a summary here of what we covered. I know we've covered a lot. And I was just kidding about the quiz. We're not going to have a quiz tonight. That's next week. But in terms of pre-venture, again, you want to make sure that you solidify your personal finances. Make sure that your credit score is high enough. I can't tell you how many businesses that we have come to us. They have a great idea or concept, but we have to tell them that their financial situation doesn't allow them to get business financing. And even that applies to in the pandemic with the EIDL loans. You have to have a certain, as an existing business, you have to have a certain credit score. And, if that's not in place, then you may not get that EIDL loan to help maintain your business. Use your financial statements to determine the viability and financing of the business. Think of, in the pre-venture mode, think of it in that you've created an experiment called your business, and you're testing the hypothesis that this business will work. So financial statements are there to put numbers in to see if the business is viable. Does your hypothesis make sense based upon the research that you've done and the available information? So definitely use financial statements. And again, the SWOT is a good tool to use. And it's a good way to do a gap analysis. One thing I didn't mention with regards to the SWOT, and I'm going to back up a couple of slides here, going back to the SWOT. Did I pass it? There we go. One of the things you want to look at with regards to the SWOT is your strengths and your opportunities that you list in your SWOT. You want to leverage those. Your weaknesses and the threats in the SWOT are things you want to mitigate. So if you identify certain weaknesses in your business or as a pre-venture, certain weaknesses that you have and you anticipate, you want to look at ways to mitigate that. So for instance, if as an existing business, and many business owners are single person firms, one of the common weaknesses is I don't have enough time. So one way to mitigate that is maybe if you have the capacity is to bring in a virtual assistant. That's the way you'd mitigate that. Or maybe on the marketing side, I don't have a strong marketing plan. Well, you might look to a third-party resource such as the SBDC or other resources that are out there, or a professional to help you develop a solid marketing plan. So while you list your strength and weakness, opportunities and threats, you want to make this a call to action with regards to your SWOT, and make sure that you address each of these areas. Again, you want to leverage your strength and opportunities, and you want to mitigate your weaknesses and threats. Ooh, there we go. So for existing businesses, again, the SWOT applies the same way, and you want to do it periodically. Because you're an existing business, you have historical financials. Use those to make decisions about the future. So it might be, if you're looking at your income statement, it might show that you haven't invested a lot in marketing. Maybe you need to, based upon the sales that you have, maybe you need to increase the budget in terms of marketing, or other decisions that might come about. You want to have a strong accounting system in place. As we mentioned before, many firms who are suffering through the pandemic, if you don't know where you are, it's hard to tell where you need to go to as an existing firm. And again, conduct periodic SWOTs. And as we mentioned before, engage a third-party resources for assistance. Don't feel you're in it by yourself. Many small business owners feel, well, it's just me. Well, you have other people that can help you, and other institutions and resources out there to help you. So don't feel you're by yourself in terms of both starting your business up, or even if you're an existing business, a lot of resources out there to help you. And lastly, have a good advisory team in place to help you at appropriate times, depending upon where you are with your business. Here's some good books here that I highly suggest. And I'll just, in the time we have left, I'm going to talk a little about what each one provides. So if you are unsure about financial statements, Thomas Idelson has a great book called Financial Statements. In the first part of the book, it covers the terminology, the semantics of financial statements. The back of the book is an example of a fictional company, and it talks about how the numbers work out, and it gives you a better understanding of financial statements. The 5 Choices is a good book in terms of decision making and where you put your attention in terms of management, and also energy. Keeping your energy up as a business owner, because you are constantly involved in your business. You ultimately have to maintain your energy levels. So this is a good book in terms of productivity. Many of us as a business owners are running projects within the business. This is a good book. The next one, Project Management for Unofficial Project Managers. This is a good book in terms of projects that you may undertake, or initiatives that you may undertake within your business, and a structured format for doing that, especially if you're not a formally trained project manager. Business Model Generation. Some of you may have heard of the term Business Model Canvas. This is the book that started it all with regards to Business Model Canvas, and it can give you some good information there. Again, if you engage a third party to help you, many business counselors can help you walk through the Business Model Canvas. And it's very similar to the SWOT. It's a back of the napkin exercise you can do in fairly quick fashion. Target funding by Kedma O. Kedma O is actually a former SBDC, Oregon State SBDC business counselor. She had this wealth of information she accumulated over time, and her book Target Funding is a result of that. This is a great way of looking for ways to fund your business. If you're looking at grants or other funding mechanisms, it gives you a great overview. And lastly, lean business planning. The gentleman here, Tim Berry, who wrote this book, he is the founder of LivePlan, Palo Alto Software, and it's a good book in terms of giving you a system or methodology for developing your business. So these are some good books to get you started. I call them the island collection. If you're on a desert island and had a business, these are the ones that you have on your bookshelf on the desert island. And there's others that are out there, but this is a good start. All these are available on Amazon, and are very reasonably priced. They're all in paperback. Lastly, I want to say thank you to the Bowie Chamber of Commerce, to William, for all that he's done. If you need to get in touch with me, the best way to do it is through William. And wishing you much success. I'll be back next week. We're going to talk in more detail about the financial statements that we highlighted in this session, but we're going to go into more detail next week. William, do we have any final questions to talk about?
No, we just have a request for a further consultation, and I did provide the email that she can contact me, and then I'll coordinate the meeting
Sure.
between the three of us, and we'll definitely do that. A lot of comments in terms of this was very insightful. Thank you. Great session. Thank you for the useful information. First of all, Charles, this was great. Thank you for doing this. I've seen your presentations and they get better every time, which means that next week will be even better. So you're
no
back.
pressure, no
No pressure at all. So next week you're going to be on again, and we're going to get deeper into these financial literacy programs. You really went deep today, so I look forward to seeing how much further deeper you'll get into your next presentation next week. So I definitely want to thank you, Charles, for being part of the team. You and I have known each other for years, and your expertise is, we always bounce ideas off each other, and just having you here is just a great plus, not just for me and for the chamber, but for all of the people who are listening, all of I think we had like 20 people earlier. And again, I want to go back and thank Pauline for putting this together. I think Terry's online as well for putting these together. And this is the third installment of the first 12 webinars. We have 25 total. And again, if the people who are saying that the attendees, we're glad that you got a lot out of this. If you feel you got a lot, tell people. We want more. We would love to share this information with additional folks. And Charles is going to be back next week, and then I pick up the week after, and just bring your family and friends and business owners onto this. So with that, I'm going to turn it over to Pauline. So thanks again, Pauline.
Oh, no, thank you, both of you. Very, very informative. And I'm going to launch a poll. If people could take a moment to just answer a few questions about the webinar, that helps us reflect. So there that goes. But again, I just want to thank you, Charles, a wonderful job. And you're showing the importance of having our ducks in a row, especially during a pandemic. And you did mention the boxes that people do go into their accountants to file their taxes, and none of their paperwork is in order. And with this money coming out in these grants, it goes so quickly. So we really need to have all of our paperwork ready to just upload it into the government systems. So awesome. Again, thank you. And I want to thank everybody for joining us. It was a wonderful webinar, and we are going to put it online too. So again, thank you. Thank you. This concludes our event, and appreciate you and everything you do. Thank you, Eric. Thank you, Charles.
Thank you, Pauline. Thank you, William.